Welcome to Skilled MBA's case study on Procter & Gamble, Balancing Money and Relationships. In today's session, we will explore a critical financial and operational decision made by Procter & Gamble in 2013, extending supplier payment terms from 45 to 75 days. P&G's objective was to strengthen its financial position by freeing up capital. However, this decision posed significant risks to supplier relationships, potentially impacting supply chain reliability, product quality, and long-term partnerships. This case highlights the delicate balance organizations must strike between financial performance and supplier trust. By the end of this session, you will gain insights into corporate financial strategy, supply chain management, and stakeholder negotiation. The case, titled Supply Chain Dilemma at Procter & Gamble, Extending Payment Terms, was published by Harvard Business Publishing in 2016. It was authored by Barry Van Zyl, E. Scott Mayfield, and David Lane. The study is 16 pages long and focuses on finance and supply chain management. At its core, this case examines how P&G had to balance improved financial performance with maintaining supplier relationships. The challenge was whether the immediate cash flow benefits of extending payment terms justified the potential risks to supplier partnerships and supply chain efficiency. To fully understand this decision, let's break it down into 4 key phases. First, P&G's original terms involved a 45-day payment cycle for suppliers. This approach balanced cash flow management with supplier trust. In April 2013, P&G announced a shift to 75-day payment terms, a 67% increase in the payment cycle. This move aimed to free up capital and improve liquidity, but it introduced new risks. During the implementation phase, P&G rolled out the extended payment structure, requiring suppliers to adapt to longer cash flow cycles. The final phase was impact assessment, where P&G had to evaluate whether the financial gains outweighed the risks of damaged supplier relationships and supply chain disruptions. This decision impacted multiple key stakeholders, each with different priorities. P&G's management team focused on enhancing financial efficiency and cash flow, but they also had to consider the long-term implications on supplier relationships. Suppliers, on the other hand, faced immediate cash flow challenges due to delayed payments. Many suppliers relied on timely payments to sustain operations, and this change could strain their businesses. Investors and analysts observed these changes closely. While improved financial liquidity was beneficial in the short term, they were concerned about potential supply chain risks and reputational damage. The case presents a classic financial dilemma: how to balance short-term financial objectives with long-term operational stability. The first issue was financial objectives. By extending payment terms, P&G could free up significant capital for investments and strategic growth. However, the supplier impact was a major concern. Longer payment cycles put financial strain on suppliers, possibly affecting their ability to maintain quality, efficiency, and reliability. Finally, relationship risk was a critical factor. Supplier partnerships are built on trust. If suppliers felt exploited, they could prioritize other clients or reduce collaboration and innovation with P&G, leading to supply chain inefficiencies. Let's examine P&G's key strengths in making this decision. As the world's largest consumer packaged goods company, P&G had substantial market power and negotiating leverage over suppliers. The company also had strong financial stability, meaning it could manage short-term supplier disruptions while implementing the new payment structure. Additionally, the extended payment terms provided immediate cash flow enhancement, allowing P&G to allocate capital toward strategic initiatives and operational improvements. Despite these strengths, there were notable weaknesses in this decision. One major concern was supplier trust. Extending payment terms could damage long-standing supplier relationships. Another issue was supply chain risk. If suppliers face liquidity problems, they might struggle with product quality, delivery schedules, and operational stability. Additionally, suppliers experiencing cash flow pressure might be forced to increase prices or limit supply, potentially eroding P&G's cost advantages. While challenges existed, this strategy also presented opportunities. One key opportunity was financial flexibility. By freeing up cash, P&G could fund growth initiatives, acquisitions, or research and development. The company could also explore supply chain finance, SCF, solutions, which would allow suppliers to receive early payments through third-party financial institutions while P&G maintained its extended payment terms. Additionally, this created an opportunity for P&G to strengthen strategic partnerships with key suppliers by offering flexible financial support programs. However, several threats needed to be considered. One of the biggest risks was reputation damage. P&G could be seen as exploiting suppliers, which might lead to negative media coverage and backlash. Additionally, supplier dissatisfaction could lead to quality issues, affecting the reliability of P&G's products. There was also a risk of supply reliability disruptions if struggling suppliers prioritized competitors offering better payment terms. One of P&G's primary solutions was to fully extend payment terms from 45 to 75 days across all suppliers. This approach prioritized the company's immediate financial goals, allowing for better cash flow management and capital flexibility. The approach: P&G implemented the extended payment terms uniformly, requiring all suppliers to adjust to a longer payment cycle. Pros of this approach: 1. Improved cash flow and working capital. P&G immediately benefited from additional liquidity, allowing the company to invest in strategic initiatives. 2. Enhanced financial flexibility. The company could allocate capital more effectively toward business growth and acquisitions. 3. Simplified implementation. With a standardized payment term extension across all suppliers, P&G avoided complex case-by-case negotiations. 4. Maximum short-term financial gains. The extra cash flow improved operational efficiency, reducing immediate financial pressure. Cons of this approach: 1. Supplier dissatisfaction and relationship strain. Delayed payments put financial pressure on suppliers, potentially damaging trust. 2. Increased risk of supply chain disruptions. Some suppliers, particularly smaller ones, might struggle to maintain operations. 3. Quality and reliability issues. Suppliers facing cash flow challenges might cut corners, affecting product quality. 4. Reputational damage. P&G risked being perceived as prioritizing profits over supplier welfare. 5. Potential long-term costs. While the company gained short-term financial benefits, the strategy might lead to higher supplier costs or supplier exits, affecting long-term profitability. Overall, while extending payment terms improved P&G's financial strength, it created significant supplier relationship risks, making it a high-stakes decision. An alternative approach involved implementing a supplier financing program to mitigate supplier cash flow issues while maintaining the extended payment terms. The program development, P&G, partnered with financial institutions to allow suppliers to access early payments at a small discount, ensuring they had sufficient working capital. Implementation strategy: 1. Financial partnerships. Banks and third-party lenders provided early payments to suppliers in exchange for a small financing fee. 2. Early payment option. Suppliers who opted into the program could receive payments before the 75-day cycle ended. 3. Continuous monitoring. P&G evaluated participation rates, supplier financial health, and any operational disruptions. Pros of supplier financing. Financial stability for suppliers. Suppliers maintained positive cash flow despite longer payment terms. Reduced supplier relationship strain. The financing program eased supplier concerns about liquidity issues. Maintained P&G's cash flow benefits. P&G still enjoyed the extended payment terms without significantly affecting supplier operations. Strengthened supplier partnerships. Suppliers appreciated the alternative funding option, fostering long-term collaboration. Reputational boost. By providing a solution, P&G positioned itself as a supportive business partner. Cons of supplier financing. Additional costs. Managing the financing program required extra coordination with banks and suppliers. Complexity in payment processing. Integrating third-party financial systems added administrative challenges. Not all suppliers benefited equally. Smaller suppliers with limited creditworthiness might struggle to access financing. Potential over-reliance on banks. P&G partially lost control over supplier payment structures, depending on financial institutions to manage disbursements. In conclusion, while this program helped suppliers maintain stability, it required significant resources and oversight from P&G. Recognizing the limitations of both solutions, P&G developed a hybrid approach that combined elements of extended payment terms and supplier financing while introducing segmented supplier management. Key elements of the hybrid approach. 1. Segmented supplier strategy. Instead of applying a one-size-fits-all policy, P&G categorized suppliers based on financial stability, strategic importance, and operational dependency. 2. Flexible payment terms. Critical suppliers received shorter payment terms, while others adhered to the extended 75-day cycle. 3. Targeted financial support. Suppliers facing severe liquidity challenges were given access to tailored financial assistance programs. 4. Phased implementation. Rather than making an immediate shift to 75-day terms, P&G introduced the change gradually, giving suppliers time to adapt. Pros of the hybrid model. Balanced financial and relationship goals. The approach protected supplier relationships while still achieving P&G's financial objectives. Reduced risk of supply chain disruptions. By customizing payment terms, P&G minimized supplier instability. Preserved supplier trust. Transparent communication and targeted financial support fostered better collaboration. Operational stability. Phasing in changes allowed suppliers to adjust without major disruptions. Cons of the hybrid model. Increased management complexity. Segmenting suppliers and adjusting payment structures required more internal coordination. Additional administrative efforts. Managing multiple financing solutions and negotiating supplier-specific terms was resource-intensive. Slower financial gains. Unlike an immediate shift to 75-day terms, this approach delayed some financial benefits. Despite these challenges, the hybrid approach was ultimately the most effective, balancing cash flow improvements with supplier relationship management. Based on the evaluation of all three solutions, P&G's best course of action was to implement a hybrid strategy, ensuring financial stability while protecting supplier partnerships. Key recommendations. 1. Adopt a balanced strategy. Implement a hybrid approach combining payment term extensions with tailored supplier support programs. 2. Maintain transparent communication. Regularly engage with suppliers, explaining financial changes and addressing concerns. 3. Implement supply chain finance. Partner with financial institutions to offer early payment options for vulnerable suppliers. 4. Continuously assess and adapt. Monitor the impact of extended payment terms and be ready to adjust strategies based on supplier feedback and market conditions. By following these recommendations, P&G could achieve its financial goals while ensuring a stable and resilient supply chain. This case study highlights several critical lessons for managing corporate financial strategies. Key takeaways. 1. Balance is critical. Short-term financial gains must be weighed against potential long-term supplier relationship costs. 2. Transparency builds trust. Clear, consistent communication with suppliers mitigates risks and fosters collaborative problem-solving. 3. Innovative solutions create win-wins. Supply chain finance, SCF, demonstrates how creative financial approaches can balance competing priorities. 4. Segmentation optimizes outcomes. Not all suppliers are the same. Strategic segmentation leads to better outcomes for both parties. These lessons provide valuable insights for any company managing supplier partnerships and financial policies. In conclusion, P&G's decision to extend supplier payment terms presented both opportunities and risks. While the move improved cash flow, it also created supplier relationship challenges. Through the hybrid approach, P&G successfully balanced financial objectives with operational stability, ensuring both long-term supplier trust and corporate growth. Thank you for attending this skilled MBA case study session. If you have any questions or thoughts, we would love to discuss them now.